I'd like to call to order this special called meeting of the Investment Committee of the Kentucky Retirement Systems. And it's my understanding that we have a consensus of a quorum of the Investment Committee Investment Committee members here. So we'll call it to order. And Vicki, could we have a legal statement?
Yes, sir. This is a special called meeting of the Kentucky Retirement Systems Investment Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statutes, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And Sherry, could you do the roll call for us, please?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins,
Here.
Ms. Bova,
Here.
and Ms. Thompson.
Here.
Thank you.
Any public comment?
No, sir, no public comment today.
All right, and the next order is the approval of the minutes of the November 20th meeting of the full committee, the full investment committee. Any comments or any corrections that we need to make? So we're hearing none. We can move with the approval of, unless there's an objection, we'll approve the minutes of the November 20th meeting. Hearing no objections, it's approved. Okay, we have a very short agenda here, and I'll give you just a, you all probably know, the background is,
Yep.
The subject of benchmarking is is one that we take very seriously. We changed one of the indexes we use for one of our passive index funds a year or so ago after a considerable study, and we don't take this lightly because there are those who properly in investment world can criticize shifting the goal line on performance, and we don't want to do that. However, it's really become apparent, partly because the 3 years of upward tilt of the public equity markets, that private equity benchmarking that uses any public benching indexes is just not accurate and leads to some bad information. So we got our staff and Wilshire on board to say what do we need to do, and ironically, we had a different benchmarking 4 or 5 years ago under the previous investment CIO, but he changed it. And so we're kind of going to go back a little bit, but maybe a much more thoughtful approach this time. So we have David with us, and Anthony is here with us today.
Yep.
We have discussed this, of course, David, previously.
Sure.
And so I think we can use the elevator version of your summation and recommendations, and
Yep.
And get people. I know David Adkins really wants to get to work on Monday morning. So
Yeah. Well, like the minute said, Pruitt went over slide number 9 at the last meeting, the areas of challenge that we have. Basically, that IRR measurements aren't the same as the way returns are measured in the public equity and other more liquid assets. And so some suggestions were made to address that. And then, so yeah, those were some of the things I've discussed. David, or anyone else, do you have any particular questions that you'd like to have answered, since we've kind of since these have now had a little bit longer to review this?
Yeah, and I thought, Anthony, we could go to the slides we added. Sherry, if we could go to slide 12 in your book. I think we added these because it gives some good color to what happens. This has all been set up well, what Anthony just said and what your minutes said. And what we're actually addressing is just one component of how you look at your private equity performance, and that is where it rolls up into your total fund calculation. When you look at the total fund returns every month, every quarter, and you see the relative difference for the fund versus the fund's benchmark, a piece of that comes from every asset class, and a piece that comes from private equity has this problem of in the short term, it's got to roll up with these time weighted returns. That's what, Pruitt referenced is they're really not totally accurate. And when you look at private equity, you want to measure it on an IRR dollar weighted basis, which you already do. And that is good. And that is the right way to measure it. And so you do that separate from just how these roll up. And so on slide 12, this shows the problems that you have when you let that benchmark just roll up the way it has been historically. And the circled areas, I'll just back up on this slide 12. This is a 3-year rolling return of as it's calculated, your private equity performance versus the benchmark on a time weighted basis. And that where we have the problem. And that is the benchmark in this case is the Russell 3000 index plus 3%. It presents you with problems in two different situations. The red circles that you see, and the first one is all the way back in the 2009 period, is when public markets sell off significantly in the short term. Your private equity performance isn't doing that. And you see this big difference, in this case, a rolling 3-year difference of about 10% from that red line, which is the index, to your performance, which is above it. So in that case, because the public market sold off quickly, you look like you've outperformed the benchmark by 10%. And then that gets a weighting and rolls up into your total fund and creates sort of a headline impact on how you look at total fund performance. When in reality, that's just a short-term distortion is all that is. The green circles show the other way around, which is where we are today. You and many other funds are dealing with this today. If you're measuring that private market performance against these public equity markets on a short-term basis, you're getting things like 20+% returns for the benchmark in a year, and your private markets isn't doing that. And so now you have that index performance way above your actual performance, and that gets connected to your total fund returns. So those are the problems. And the recommendation to solve this was, your minutes said it, we talked about a neutralizing approach, where only when we look at these time-weighted returns, you just let your private equity performance let the benchmark equal the performance. And that way, when you look at the headline of the fund, the total fund returns, you don't get this volatility in your relative performance that comes from these things in the short term. And what matters most is that's not all that you do, but in separate reporting, you do the proper reporting of internal rate of return calculations, which you're doing, and then you measure those against what's called a public market equivalent, and that is a measure of putting the same cash flows in the public markets and seeing what that would look like. That is an investable benchmark. You can see how you're doing there. We run that quarterly for you. You're outperforming those public markets. That's how you, as a governing body, should be evaluating your private equity performance. So the recommendation is get rid of this problem with this sort of volatility affecting your total fund reported returns, but in every one of your quarterly meetings, have a separate page. It could be one page, it could be 2 pages that shows how your private equity is doing properly on the dollar weighted basis versus its benchmark. So that's the recommendation in a nutshell.
Okay, do we have any questions or need any more discussion of this? Well, hearing none, then
Pruitt,
yes, sir.
sorry. I'm too stupid to really navigate this, so I just need someone to help me with a few, I guess, just reconciliation questions. But how would this decision impact or deviate from what the actuaries are doing to determine the funded ratio?
Oh, this would have no impact on that. David.
Okay.
Yeah.
Okay. And so if one were just looking for a characterization, would this change result in a more conservative approach to reporting market returns, or would it be likely to benefit people who wanted to show greater market returns?
I think, like
This-
you said, it would. This slide here just shows you, right? Like in the red periods, we look like all stars because we have less equity exposure, right? And the private equity doesn't go down as much, so you look like like you killed it. And if the equity markets go up a lot, you look stupid because you lag it by a lot, like right now, right? Like the private equity looks like. I think there was a couple quarters recently we were lagging by like 2,000 basis points or something, because the public market was up like 25%, and and private equity is up like 7 or something. And that's just not really an accurate way to look at how private equity is doing, right? It's just comparing two different things. Like the index plus a percentage is an easy thing to do, but it's also not investable and it has distortions like this chart shows. So that's kind of the point. It's not necessarily benefiting. It just is distorting. It's more like I would say it's more confusing. And you just have to explain it every time.
Back to your first point, in terms of the actuaries, they're using very long-term numbers.
Right.
And I think that there's, I'll go out on a limb that over a 5 to 10 year period of time, the convergence or the realization, if you will, of the returns from the private equity that we're hoping to get 9, 10, 11, 12%, who knows what each one's going to do, that's going to be realized and will show up in the number that the actuary is using. But the actuaries are, they're long-term guys and girls.
Yeah.
Yeah,
I guess
I'll-
what I'm trying to get at here is, there was the, and there may not be a correlation here, but the tendency to have an assumed rate of return informed by various data points. There's always a temptation from public pension funds to try to increase that assumed rate of return.
Right.
We have been very sober-minded, as many states have been, after problems when assumed rates of return were close to 8%, and people were missing that, but it did screw up the actuarial calculations and masked some of the unfunded liabilities. So I just want to make certain that in making this change, we're clear with our members that this doesn't have the effect of gaming or inflating rates of return in the short term to the benefit of those who manage the fund, but potentially, it doesn't artificially inflate assumed rates of return, which are what actuaries should be focused on.
Right.
Anytime we're changing benchmarking, there's always the possibility that someone would accuse folks of saying, well, you're gaming the system. And particularly in this particular case where we're in a period of the green circles, it may look like we want to put our thumb on the scale and say we'd rather look better. And so we're changing the rules of the game. So I appreciate the explanation of what this is and what it isn't. And I guess my last question is about if we have the Russell 2000 as our benchmark for what we would, a benchmark for if we had taken the cash that we put into private equity and just put it into the market, a Russell 2000,
3,000.
3,000. Will we report the difference between
Yes.
those things such that it's the classic case of a individual investor being told just put your money in an S&P 500 mutual fund, keep it there, and you're going to outperform everybody who's picking stocks and trying to be smarter than everybody else. And I would at least like to know that this tendency right now towards private equity, and those who are championing it because they have fees to generate, but it is clouded in a lack of transparency. Much of the gains in private equity sometimes involve incurring debt and spinning things off. So I just want to be very clear-eyed about where we head with private equity. Clearly, there are returns to be had, but there's a lot of nefarious stuff embedded there that I would like people to have a clear understanding that a dollar put in the whole market of equities may have less risk and still greater returns than the risks associated and lack of transparency around private equity. So I guess
Yeah.
that's just my concern that
Yeah.
this wouldn't change
That's a
that.
concern for a lot of people. And I think if you look at page 16, the solution, the recommendation, I think that you can see the PME, that's what Dave was talking about, the public market equivalent. That's what does that. So it says the same exercise, but it's more done by fund, right? So if you have this manager and they called capital at this date, so instead of sending the capital to them, you send it into the, to the index, and then you compare it. And then, that's how you can tell by fund how it's doing. I mean, we can't do that for if you, it doesn't exactly roll up because they all call at different times, right? But so that's something that we utilize to evaluate individual managers, see how they've been doing, and if they're adding any value, or if, like you said, we would be better off just sticking in the market and not doing all this brain damage and paying fees, right? So we definitely are in agreement on that for sure.
Yeah, and David, the along with the recommendation is to show that quarterly at a higher level at the total private equity portfolio level, because that's probably easier for the board, to track. And what we can tell you, those numbers have been calculated on a regular basis for you. We do that quarterly. We'll put that, if you approve this process, we'll begin to put those, make sure those get to your books each quarter. But historically, over the last approximately 20 years, you are ahead of investing in public markets by about 2% annualized for your private equity program in totality. And that's the number that I think you, as a governing body member, want to be able to track. That'll answer your questions about, are we being successful by investing in these private markets?
And David, does that include net of fees?
Yes, that is.
So it is actual return.
Yes.
With all costs.
Yes. You pay us to calculate that for you, and we will show you that.
And does that include in-house costs that might be greater to manage private equity as opposed to?
It does not. It does not include your internal management and administrative costs.
Okay.
Yeah. So
can it?
Yeah.
Can it? Oh.
That would make it a bit complicated, but it's a very pure measure of the performance of the program and all of the funds, net of all of the fees that you pay to have those funds managed. So you'd have to add a component if you wanted to somehow charge out internal office costs to that. It's doable.
Yeah. All right. Thank you. I appreciate it, Mr. Chair.
Thank you. All good points to be made, and certainly David Lindbergh's point about the long-term success of significant, and 2% is a
lot.
Those of you remember David Eagers, he doesn't use percentages, he used dollars. David would jump in and talk about how many millions of dollars that is, and which is not all bad. So if we're ready, there's nothing else to comment on or ask. I would like the recommendation to be, if it's okay with you all, to be exactly what's on the screen now, the recommendation for KRS Investment Committee, so that we don't get either off track or whatever on it. So if someone is ready to make that recommendation, we'll hear it.
I would move that we accept the recommendation as proposed and forward it to the full board with a favorable recommendation.
Thank you. And we'll call that the neutralizing approach, if for lack of a better handle on it, and without getting into all the details. So we have that recommendation from the investment committee to take to the full board. And we'll just do a roll call vote just to make sure.
Yes, sir. Mr. Lang,
Yes.
Mr. Atkins,
Yes.
Ms. Bova,
Yes.
and Ms. Thompson.
Yes.
Thank you.
The motion passes and we will, we will bring that to the full board, at our next meeting. And with that, I don't believe we have anything else on the agenda. So we'll have the ever popular adjournment. Thank you all very much for your time.
Thanks.